Welcome to Tradiers, the Trader's Edge. I am Jim Iuorio. That's Bob Iaccino. First, on to important stuff. If the backdrop here looks different, I'm in my studio in the city, which I usually don't record from, but I had to stay extra because of the FOMC day, which I don't have access to my regular coffee. So I got Dunkin' Donuts coffee, which, by the way, is trash. Bobby and I are both coffee connoisseurs, and we will be talking about a big coffee announcement coming up in the next couple months.
Coming up.
But this coffee is crap. Do you like Dunkin' Donuts coffee or no?
I haven't drank a cup of black coffee that I purchased in, how old am I?
Oh,
I want to say like 42 years.
And you work out of your home now too, so you can just always just pop into your kitchen and make it. Which, by the way, I'm truthful and I don't lie, but if Dunkin' Donuts wants to write us a big sponsor check for this show, I will say that your coffee's great. That's one thing I will lie about. Okay, just so we're all clear on that. Okay, the Fed was today. Big deal, little deal, no deal. He didn't do anything. We didn't expect him to do anything.
I think the statement itself was a big deal. And I'll tell you why. When I looked at the statement, I saw a couple of things. Number one, they took out the language, and I'm paraphrasing, I don't have the statement in front of me, but they took out the language that inflation is making, I'm going to look it up. They're making progress towards their 2% goal. Right. That's basically what they said.
Yeah.
They took that language out. The second thing is that they sort of gave the impression that employment is stable at a good rate. Not that it's rising, not that it's weakening. They didn't give any sort of implication that labor might be a reason to continue rate cuts. So I saw that as kind of I don't want to call it a big hawkish shift. They also said they don't need to rush to cut rates anymore. And rush is not the word they use. They don't need to be in a hurry, was I believe the word they use. And then lastly, every single freaking question in the press conference was, so how do you think President Trump is going to deal with you not lowering rates? And then President Trump asked you guys to lower rates. Did you guys listen? And then what does President Trump think about your choice of ties? It was like unbelievable. Even like our old friend, Steve Leisman, I never liked him. He said, basically, I have three questions for you. And when he asked the three questions, Jerome Powell said, so one question. Yeah, we're independent and we are based on the data, because Steve basically was talking about how much pressure Trump was going to put on the Fed.
Can I add something that real quick before we bring in the guest? Is that Trump comes out and says, I want lower interest rates. I don't remember him demanding lower interest rates. And here's the thing, is that he says it out loud and it's transparent. Guess what every one of his predecessors does? They go to the Fed in secret and whisper to them threateningly that they want lower interest rates or else. This is nothing new for a president to put pressure on the Fed. Trump just does it loudly and vocally because he's bombastic. So people, don't get your panties in a bunch anymore. It's not that big a deal. It will be a big deal if Jerome Powell crumbles like a house of cards and starts lowering them because of Trump. I don't foresee that happening. That's fair, right?
Yeah, very fair. And I'm digressing a little bit here, but so is we are now run by billionaires, because look at the inauguration. Elon was there. Bezos was there. Who's the guy from Apple? The guy with the glasses from Apple. Tim Cook was there. We're now run by billionaires. When were we not run by billionaires?
Yeah, you know, Rockefeller. Yeah. Rockefeller did, like, he was so involved in government. It's just, the whole thing blows me away. We've always been run by billionaires.
Real quick, last thing on the Fed from me. I think they actually are starting to believe the thesis from our next guest.
Really? Okay, good. Because the thesis from our next guest was important. And by the way, he talked me around several different times when I thought the economy was collapsing 6 months ago, 8 months ago. You know, he is one of our favorites. We think he is absolutely brilliant. And I've said a million times, you guys can watch Bobby and I, our entire 25-year media careers, and think that we're full of shit. That's perfectly fine. We sometimes think we're full of shit, actually about half the time. But one thing you cannot deny is we get some great guests. And this is not going to be any exception. We have one of our favorite guys, Mike Singleton from Invictus Research. We've already once, before we came on the air, given Mike a hard time. Because as you know, we've seen these interviews where Bobby and I are loud and our hands go. And Mike just sits there and goes, Well, no, Jim, you're incorrect, and this is why. And I like that about him. But let's start with some foolishness. Were you excited about Notre Dame's good run in the football playoff? And did you watched all the games, didn't you?
Oh yeah, of course I was excited. Past tense. You know, I didn't like the final outcome, but up until the last game, I was excited. Yeah.
Did you really believe, like in your heart, that they had a great chance of winning that championship?
I thought America was back. I thought we were going to win it.
America's back. Make America great again. Make Notre Dame the championship.
I'm seriously leaving the show.
The show is just not worth it anymore. That Ohio State team was a machine, I thought. Well, I was echoing somewhere, but I thought that Ohio State team was great. I thought Notre Dame played well in the championship. I thought they were going to get blown out, and I'm sorry about that. And by the way, my son-in-law now is a Domer, so he's now part of the family. So I've gone from a Notre Dame hater to, I'm not your level of Notre Dame lover, but I'm getting close. I root hard. So anyway, there's that. That's not a question, I know. So let's move on to questions. First of all, before you said the Fed was exactly as you expected, you thought there was nothing that really interesting came out of that. That's correct, right?
That's more or less my take. When we do the daily edge at Invictus, we structure it as the top 3 things that matter and the top 3 things that don't. And I think that this Fed meeting is probably an instance where it doesn't matter.
Yeah, I think so. I agree with you too. I mean, I saw it. The markets didn't have that much of a reaction to it. What does matter?
So really, in any given economic regime, at any given moment, there's always 3 things that matter: real growth, inflation, and monetary policy. The importance of monetary policy is less important when nominal growth is really, really high. Generally speaking, at least for stocks, monetary policy is most important when earnings growth is close to 0 and interest rate volatility is high, right? When what the Fed is doing is really significant relative to what the economy is doing. And right now it's sort of the opposite situation. We're talking about marginal tweaking in monetary policy, pause, maybe cut 25 basis points, probably won't see a hike. And at the same time, nominal GDP growth is 5 to 6% and accelerating. So you have a real economy that's moving quickly and matters a lot, and you have monetary policy that's just sort of marginal importance at this rate. Our view at Invictus right now in terms of the economy is reflation. That means faster real growth and faster inflation at the same time. I think we could see 3% plus real GDP growth for the next several quarters, and happy to get into inflation in more detail if you would like. But just the last reading, headline CPI increased, I think it was 4.7% at a month-over-month annualized rate. Haven't heard anyone frame it that way, but that's substantial. That's really fast. Most of the inflation data is still accelerating. Core is kind of the exception for now, but generally core follows headline, not the other way around. I think a lot of people don't appreciate that.
So I know that you don't think this Fed meeting mattered. Let me try and hit you with why I think it did. I think in the statement and subsequently in the press conference, we essentially got an admission from the Fed that inflation is not beaten. Now, will that matter for your overall thesis? You're a business cycle investor, and you can explain what that means when I'm done with the question. But in terms of the way that they framed the statement, I'm not one of those people that goes line by line. I'll actually reach out to a specific person I know that does go line by line and say, hey, what was different? And she honestly couldn't get over the fact that they took that progress toward 2% inflation target because of what I've learned from you in the Daily Edge at Invictus Research, that inflation is not really moderating as much as you would like to see. So I'm thinking maybe they see that. Now, you add in some of the things that may happen through the Trump administration. I know that also doesn't matter to you in the short term. So what do you think of that? And what do you think this means for inflation? And give your thesis on specifically inflation and why it hasn't moderated.
So I think the primary reason it hasn't moderated. So first of all, let's just acknowledge that it really hasn't moderated. And when I say that, what I mean is shorter term measures of inflationary momentum are accelerating, even though the year-over-year data is declining largely due to base effects. So when you look at the month-over-month annualized data, it's higher than the 3-month annualized data, which is higher than the 6-month annualized data, which is higher than the year-over-year data, right? That's just another way of saying that it's accelerating, but that acceleration isn't visible when you just look at sort of the headline figures. And for the last few months, mostly policymakers and sort of the Wall Street consensus the headline figures, and they've ignored sort of what's happening under the surface. So why is it happening? I would say primarily because of the labor market. And again, this is sort of counter consensus, because if policymakers, if the Fed believed that the labor market were still pretty strong, pretty resilient, they probably, they probably wouldn't be cutting rates. Part of their thesis for cutting rates was the balance of risks has changed. Inflation is coming down, and now maybe we're worried about the labor market. At Invictus, we never really thought the labor market was at risk, and there are a variety of reasons that we thought that. But anyway, here's the cash value of what I'm saying. The tighter the labor market gets, the faster wage growth tends to be, the more resilient wage growth tends to be. Right now, when you look across the various measures of wage growth, we see wage growth in sort of the 4 to 4.5% range, probably closer to 4.5%. That's just not consistent with 2% inflation. One model that the Fed uses is inflation over the long term is equal to wage growth less productivity growth. Long-term productivity growth in the US is probably about 1%, right? So 4 to 4.5% wage growth is really consistent with, 3.5% inflation or thereabouts. And, until wage growth starts to cool more meaningfully, more sustainably, it's hard to imagine long-term inflation troughing out at 2%, which is what the Fed wants. So that's kind of where we are now. I'd also add, just sort of on a technical basis, to me, it looks like oil is bottomed, and there are a couple of reasons that we think that. I can get into them in more detail if you'd like. But if oil has bottomed, that's really problematic in terms of inflation policy, because oil tends to lead the inflation data with a surprisingly close correlation by 2 to 3 months. And if we get this reflationary impulse reflecting in the price of oil, it's just hard to imagine either headline or core going down. Again, a lot of people don't realize this, but oil and core inflation still correlate, and the price of oil really leads core inflation for some reasons we can talk about in more detail. But basically, higher oil prices is bad for Fed's inflation policy. And if oil is bottomed, like we suspect it probably has, the line of sight into 2% inflation just gets more difficult, and it's already kind of difficult. So I don't know when we get to 2% inflation from here, but I don't see it anytime soon.
All right, so just a quick follow-up. Caroline Leavitt, she's the new press secretary for President Trump. I watched her press conference yesterday, and one thing she specifically said, somebody said, okay, you've deported, I think it was 3,500 people, might have been 2,500. And you said, were they all criminals? And she said, yes, because the minute you cross the border illegally, you're a criminal. I'm paraphrasing, right? I know people in some of the larger cities, especially in like the restaurant industries. Little known fact in terms of like picking fruit, there is a program where you can come across legally to work in the field. So I'm not worried about that. Plus, only about 1% of the agricultural workers are illegal immigrants, according to data. But restaurants, things like that, they're very nervous. Trump administration and Tom Homan said they were going to go after criminals, right? And then the press secretary yesterday said, if you cross the border, you're a criminal. So I think that at least describes the biggest fears of people who use this particularly cheap labor to make their businesses run. Do you see any problem with that in terms of what you just explained to people on the wage side of things? Is that too small? Is that like a rounding error? Or is that enough to actually be another sort of a spike in perhaps goods inflation, not just services inflation?
So
that's a lot.
If illegal immigrants get deported, that's going to tighten the labor market more than likely, because the supply of labor goes down, which puts upward pressure on the price of labor, which is wages. That should flow through to the inflation data through the services economy, sort of like you just described. It's all very, very consistent with the data. Is it a problem for stocks? I would say no. Is it a problem for businesses? Possibly so, but I don't think it's a huge problem on the national level. I mean, generally speaking, what you want to see, even if you see sort of above target inflation, people tend to feel good about it if real growth is accelerating at the same time. So, it's a balancing act, right? Like, I think that a labor shortage will put higher pressure on wages. It'll sort of reduce margins in the services industry. I think all of that's possible. I think it maybe is even likely in certain instances. But that doesn't necessarily mean stocks go down. And it doesn't necessarily mean that, it gets reflected in consumer confidence, or I'll tell you what, the small business data, a lot of these businesses you're describing that might suffer from this labor shortage are surveyed in the NFIB small business survey of small business trends, and they're extremely optimistic. I mean, if they're worried about a labor shortage, it's not getting reflected in the data. We've seen the largest 3-month improvement in small business sentiment since the data has been collected in the 1970s. So, I think we just probably have to watch the data as it comes in and sort of adjust our opinions as we see new data. But so far, it does not look like something I would predicate an investment thesis on.
So lastly, and then I'll let Jim talk for once. One of the things is it possible that sort of the wage growth catching up to inflation, right? Because we do still have a gap from the initial spike in inflation, do we not? If I'm wrong about that, tell me when you answer. And is it possible that the catch up of inflation from a data perspective could mitigate the effect on inflation in the short term, or no?
Yeah, 100%. So the statistic that generally corresponds to real wage growth is productivity, labor productivity, and forecasting productivity is very difficult, but there are a handful of things that we know are generally associated with improving productivity, one of which is lower oil prices. So if President Trump is successful in really boosting, the amount of output of US oil, and it's enough to move the needle such that the price of oil goes down, that's almost it's free GDP points. That's flows directly into the labor productivity data. You might have better insight on that happening than I do, but that would obviously be a good thing. The second is deregulation. Deregulation is virtually always accretive to both productivity growth and GDP growth. It looks like that's happening right now. So, if there's any chance, I think that if certain things President Trump is doing are inflationary, like the deportations, but a lot of what he's doing is disinflationary. We just listed 2 of them. Drill baby drill is clearly disinflationary if it happens, and there's no reason to think that it won't, unless you're looking at the technical data on oil. I think that's sort of a question mark. And then the other is deregulation. Deregulation should be theoretically Goldilocks, right? According to every economics textbook, it should be a downward pressure on inflation and an upward pressure on real growth. So to the extent that happens, that's the opportunity for workers to see, real wage growth really start to accelerate.
So there's something I'm going to disagree with you on, which the last time we disagreed was probably a year ago when I said, looks like a recession's coming, and you said it's not. And it turns out you were right, which I haven't forgiven you for that yet. But this one, I'm going to disagree with you again. And let me preface the question by saying this, is that one of my investment thesis for Trump presidency, actually this probably started about a year ago, is that inflation was going to stay naggingly, persistently high, probably in the 2.6 to 3% range. And I thought commodities would do well in that environment. So, including Bitcoin and real estate, which is a lot of what I'm involved in right now. And it's done well. It hasn't exploded like I thought it was. Now, here's the part I disagree with. You said the Fed wants 2% inflation. I don't agree. I think if you cornered the Fed, Jay Powell, gave him a couple bourbons and said, tell me the truth. If you could lock in 2.4% for the next 3 years, and then we could somewhat inflate our way out of this ridiculous debt that's not just accumulated at the federal level, but at the state level, at the county level, and we can monetize some of that debt, would you take it? I think he would answer yes. But you said that they want 2% growth. I think he's lying. What are your thoughts?
So I think I would just frame it differently. I think if Chair Powell could snap his fingers and get 2% inflation, the answer would be yes. If I asked you, would you like $10,000? I can snap my fingers. You'd probably say yes. But if I said, hey, I want you to come work with me and that'll be your annual salary, you'd say no, right?
Sure.
It's a question of the trade-offs that you're willing to make. And I think Chair Powell wants other things more than he wants 2% inflation.
Okay.
It's about the balance of risks, right? I think for some reason, he and policymakers more broadly have been very concerned about risk to the labor market, even though I see very little data to that effect. And he views those risks as so significant, he doesn't want to tighten monetary policies substantially from here, which is, right or wrong, that's what he's doing. And I think our job as investors is to react to that. You could also make projections about maybe some other things that he wants to be reappointed as Fed chair. Maybe that's motivating his decisions. But even that's just an instance of sort of weighing trade-offs, right? How much pain am I willing to accept myself? How much responsibility for, bad outcomes, getting fired, a recession, more layoffs, how much am I willing to trade for 2% inflation? That's the way that I think about it.
No, and I like that. And again, that part was just for conversation because I don't care why or what's in the chairman's head. As Bobby has said a million times, our job is to react to what we think the reality is. And I think the reality is going to be higher inflation for probably the next 2 years. Do you like my investment thesis off of that? And I'll go over it again. I like the metals, particularly industrial, platinum, which hasn't made its move yet, but I am long it, silver, gold to a less extent, Bitcoin, things like that because of a persistent inflation. Do you like those plays?
I do. I think that generally speaking, investing in commodities are almost a quintessential reflationary asset. And if you just map the price action of something like the CRB index to CPI, they look very similar over time. So, 9 times out of 10 through an economic reflation, commodities are a pretty good bet. And Bitcoin has been like, any kind of back test you run on Bitcoin, everything looks great because it's performed so well. So yeah, I'm bullish on Bitcoin as well, both sort of structurally and tactically too.
So I don't, I watch your stuff every single day. It's one of the first things I do. It's always at the top of my list here. It says, listen to Invictus, right? It's the first thing I scratch off on the beginning of the day, but I don't take your trade recommendations because they're longer term than I do. My average hold time is like 26 days and you're a business cycle investor. I remember you, I don't want to say shit talking because that's not the right phrase. You never do that, which I'd like to see more of it.
We do it all the time. Mike,
yeah, we do it all the time. But you were, I can't remember when it was. You'll remember because you're like that. You were not a fan of an investment in gold. It might have been toward the end of last year. And I don't know if that switched or if you're just not against it. Can you talk about that a little bit?
No, I did switch. I'm trying to remember exactly when it was, but it was maybe halfway through 2023. And the reason was, one, the technicals look good. And I don't like fighting the tape for so long. I think that's, I can't think of a better way to lose money over time. But it was an environment of higher interest rates that's generally bad for gold. From 2000 until 2019, there was almost a 90% inverse correlation between the 10-year real rate and gold. So my view at the time was higher real rates, probably lower gold prices, and higher real rates happened, but gold continued to perform well. So that's, that should have been my first signal right there. On top of that, there was really crowded speculator positioning in gold, which historically has tended to reduce your probability of good forward returns. And gold continued to do well anyway, and positioning sort of reverted. And so eventually I got to a place where I was like, it probably took me too long, to be honest. It got to a place where like, okay, well, gold is outperforming despite all of these negative catalysts. There's something going on here that I don't fully appreciate. Maybe it's central bank buying. I think in retrospect, it was central bank buying. I think that gold, it's hard not to be bullish gold here and long gold here, particularly on sort of a technical and positioning basis, because it looks like there is, a decent tap of demand that's just not running out. And, as an investor, when something goes up and it should be going down over and over again, I find that's generally an asset that you want to look to own rather than look to sell.
Bobby, my question is going to be for you because I believed that going into the election and the weeks before that, gold was priced in some way for a Kamala Harris win. And I thought Kamala Harris would have been the perfect president and administration for gold. High regulation, high spending to combat that, people running and hiding into something. Mike mentioned central bank buying, which I think has been a huge tailwind for gold as well. So gold plummeted 9% after the election in about a 3-week period. And since then it's gained footing. Now I think it shook off that because I had said a million times, Kamala Harris is great for gold. Donald Trump is good for gold. We priced out great and we put back in good. But now we're on the move again, and the central bank story is still there. Thoughts?
So a couple of things from my perspective. Number one thing that there's Taylor. Taylor's
correct. Coffee Mars. Yeah. Coffee. I wish I was looking and trading coffee more. I'm drinking a lot of coffee, Taylor, but I'm not trading it as much, and it's gone through the roof, particularly with the Columbia thing. Sorry to interrupt. Yeah.
No, it's okay. We love Taylor. Taylor's a good guy. He's one of the good guys that came from the evil empire. I won't say where. CNBC. So gold futures, to me, I'm speaking specifically of gold futures. I think that gold futures sold off after the election because there was going to be sort of an entire new narrative about what would affect gold. I think the Goldilocks thing happened after the election. Trump's going to bring the price of eggs down, right? Already the media is saying eggs are up. What'd you do wrong, right? Trump's going to drop energy prices. The media is not asking Trump how he dropped energy prices so quickly, right? They're not doing that. But I think prior to that, the narrative was this. Gold is not an inflation hedge unless the Fed is not fighting inflation.
Bingo.
And part of the reason that I stayed in it was because I was convinced by the guy on the screen here that there was a lot of reasons to think that inflation might not be heading toward 2%. Yet the Fed was still in an easing cycle. Even though they eased 3 times in 2024, we weren't sure what they were going to do in 2025. When you looked at the CME Fed Watch tool, they had us going all the way down to like 250 on the Fed funds rate. And so what would that have been at the time, Jimmy? 6 more cuts, 5 more cuts?
Yeah. Yeah. Like 175 basis points of cuts at the top, I think. Yeah.
So I said, not only is inflation higher as per Invictus research, right, which is what I believed, I turned to believe when I started looking at other things plus his work. I said, the Fed doesn't see it. And that to me is when gold is an inflation hedge, because at its core, it's an asset. And with price inflation that is not being derailed by Federal Reserve policy comes asset inflation, including stocks, which Invictus was also right about. Any of that makes sense?
Mike? Yeah, it makes sense to me. Mike, thoughts?
Yeah, I think maybe another way I would say it is, monetary policy is too loose given prevailing economic conditions. And when that's the case, you generally see gold go up. Usually that's reflected in lower interest rates. In this instance, for whatever reason, rates are kind of high, right? 10 years pretty close to 5% and gold's near all-time highs. I wouldn't have, I think I was too data dependent when I was sort of coming into this cycle, because again, like historically, the 20 years leading into COVID, the inverse correlation was almost 90%. I mean, it's one of the closest relationships in financial markets, and it decoupled here. But my intuition is that it decoupled for the same reason that the correlation existed those previous years. Monetary policy was too tight relative to, or too loose relative to economic conditions. And I think that's probably still the case when you look at the inflation data.
Hold it, but they also exploded the debt too. That's affected gold as well since COVID, correct, Mike? Okay, good. Yeah.
All right, so I want to read Mike's Veletute, sorry, Michele.
Tutte means all. Vele, I don't know what it means, but I know Mike. He's a good man. Yeah, but anyway.
Yeah, so anyway, he says without hiring, job cuts will show up fast in the data. Fed will be reacting, lagging data. Now, Invictus and Singleton, actually, I know he has an opinion on this. So go ahead.
Mine and Mike's opinion are going to be opposite. Mike, you go. And he's smarter than me, people.
So I agree with the premise that hiring rates are low, and that if job cuts happen, low hiring rates will obviously cause all of the unemployment data to look worse quickly. I just don't see any evidence that job cuts are on the come, right? We have pretty good high frequency data on this, and basically layoffs as a percent of the labor force are lower than they've ever been, going all the way back to the 1960s. And when we look at, we look at all of the labor market data at Invictus, on balance, I would say that the labor market is tightening. It's not softening, right? The odds of layoffs are lower today than it was 3 months ago, 6 months ago, 8 months ago. And so, we think that we're a ways from significant layoffs. And I don't see what the catalyst would be for that. I will say, actually, I do know what a potential catalyst would be. We have seen weaker hiring activity in cyclical sectors like home building and manufacturing. And I don't think that continues, let alone metastasizes to the rest of the economy. But, I will acknowledge that hiring trends in those industries, which are important, have been soft for the last 3 to 6 months. But you don't see it in the headline data because the rest of the economy has been so strong.
So after we do the banner, I will give my opinion, which will change everybody's life because it's going to be so brilliant. But it's called, what do they call that in the media world? Is you bury the lead, and then we'll talk about it in a second. But we are now going to run the Tradier Options Pro, Tradier Pro options platform banner. So if you guys trade options at all, this is a must. This is a free opportunity. We've had options professionals, professional option traders on here. When we mention Tradier Pro, they say, oh yeah, it's the only thing I use. That is honest to God truth. And they didn't even know, they barely even knew we were on the Tradier hub when they said those things. So you can get it for free for 3 months with absolutely no obligation. Please click on the link that we provide. And all we ask you to do is give it a try. We ask for no dollars out of your pocket. Now, back to my opinion on this. I think the labor data we've seen over the last 2 years, there's a lot of things that troubles me in it. The government hiring, the healthcare education hiring, the second, third side hustle job hiring. I'm not saying it's a house of cards. I'm saying, like, if a house of cards is here, I don't know what here is, almost to halfway of it being a bunch of bullshit. I think there's a lot of strength in it too, but I do think it could turn relatively quickly. So I think I'm a little more bearish on the labor market than you are. Does that make any sense to you, Mike?
Yeah, it does. And though I fully concede that those are all labor market risks. I'm probably weighting the other evidence higher than the evidence you described, but it's there. It's good to be aware of it. I think you're right.
Bobby?
Yeah, I think you're right. I mean, definitely, especially like, I don't remember who it was that said to us, Uber drivers, like they just don't show up. I think a big part of it too, tech layoffs came with pretty large severances. So you could have people sort of, just kind of hanging around, but the layoff numbers are the layoff numbers, because they don't show up in jobless claims is weird to me, because I haven't seen anything like that before. But the layoffs came pretty quickly in tech and then just kind of stopped.
Yeah.
So they
well,
may
what
have
about quit rates?
Mike, I don't really see what the catalyst would be, but the quit rate thing, like the whole JOLTS job data thing, reminds me of rig counts from Baker Hughes back in like 2014, 15. All of a sudden it became the most important thing that we needed. Then it was hurricanes. We all needed to be weathermen in like 2017 because hurricanes were higher than average. And we all needed to predict the weather and watch the hurricanes. JOLTS jobs data became an important data point along with the quits rate very recently in terms of the history of how long you and I have been doing this. You and I were on the trading floor together. I never said to you, did you see those quit rates?
Right. Yeah,
but
not once. Yeah.
I could be wrong.
What's Widget's comment? Can we put that up?
Yeah. Go ahead, Jimmy.
Normalizing the price spike of 2021 and 2022 using inflated prices as a baseline for future 2% inflation targeting has been a horrendous policy decision that needs to be broken. Okay, this is interesting. Let's break this down. So what do you think he's saying, Bobby? Is he saying that just the notion of a 2% target is horrendous policy that needs to be broken? Is that what he's saying?
I think he is. I think he's saying that if you take that spike out of it because of base effects, then it's impossible to say that we reached 2% inflation. It's fine. I think that's what he's saying. Correct?
But this is where I might be disagreeing with him because they have to do this. The price spike was essential to bailing out all these heavily indebted government things. So I mean, they needed to pay back in cheaper dollars, in my opinion. This is odd for me to disagree with Widge too, because he's a bright guy, unless I'm misinterpreting. Mike, do you have anything on this?
No, real quick before Mike chimes in, I think what he's saying here, and again, Widge, chime in again, please, because Widge is a regular viewer and we interact with him a lot on other platforms. I think he's saying that a target of 2% inflation after we had a 20% jump is insanity.
Yeah, and this is the part I think it is insanity. I agree with him, but I think that that's exactly what they're going to do. They literally wanted to devalue the dollar by about 30% in order to make our debts look a lot better and more manageable. I live in Illinois. Illinois is essentially a bankrupt, ridiculous state, unless, of course, there's way more dollars being thrown into the system. Mike, what do you got?
So I understand what Widge is saying, and I think that that's a completely fair point. If you're more poor today than you were in 2019, who cares if the Fed just hit its 2% target?
Great point.
But I'll say that tradition, in terms of like setting expectations, I think that generally the way that quality of life improves isn't because the Fed managed to cut inflation managed to deflate the economy. That just never really happens. Usually it happens because there's some kind of productivity boom that improves real wages. So, generally what I'm rooting for is faster real wage growth and improving productivity as a result of lower oil prices, deregulation, maybe artificial intelligence. I have very little faith that the Fed will gracefully deflate the economy without causing a recession, because I think they've never been able to do that.
Amen.
Well, let me ask you, Mike. So is there any room for deflation? I mean, I came up thinking the worst possible thing for the stock market is stagflation. That's what I was taught. That could be wrong. And then obviously we just have recession, where prices are going lower and prices are deflating is the way I view it. And economic growth is low or even negative. So when looking at it from that perspective, is there any room for deflation in this particular cycle? I don't think we're going to get it, but is there room for it? Because it's obviously the thing the Fed fears the most, right? They've said that.
Right. So it's definitely not our outlook. That doesn't mean month to month there can't be deflation, where just as a result of economic frictions or record keeping mistakes or whatever, some measure of growth declines at the same time as some measure of inflation declines. But I do not think it will be durable or sustainable. I'll also say that from an investment perspective, that's a good thing, just because historically, when you look at, if you backtest any risk asset against the economic data, except for maybe bonds, deflation is just the worst. It's the worst economic regime for all sectors and style factors and all of the indexes. And so, at least through stagflation, some things go up, and deflation's basically nothing goes up except for bonds. So it's a very difficult environment for investors.
So here's what I think all of us would agree on. And some people might look at it and say it's hypocritical. I detest runaway inflation. I think it disproportionately hurts the poor. I think it is insidious. I think it's awful. I think it's, stealing the rich man's labor the poor man's labor for the rich man's assets. That being said, I'm also terrified of deflation. And I do think a Federal Reserve and a government should be very, very cognizant of any sort of deflationary pressures, because that could turn into a spiral as well. So I hate deflation even more than I hate inflation. 2%, the notion that they picked it, and it's obvious how they did it. They were like, dude, what do you got? 3%? No, it sounds too high. What about you? 1%? No, that sounds too low. Let's go with 2%. That's why they targeted it. There's no science behind it. Do you agree, Mike and Bobby, then next, that deflation really is the boogeyman that it's made out to be?
I don't think deflation is necessarily bad for a citizen, for a person's quality of life in terms of the goods and services that they use and the experience that they have every day. I think it's very, it's bad for stocks, if you want your stock portfolio to go up, but those are two different things, And so I try and separate in my head. There are periods, like, I forget exactly what the years were, but there's a period in the late 19th century where CPI was declining, and I think stocks did poorly, but, generally, people were pretty happy. And just in principle, it makes sense. You can understand that a world where prices are declining isn't bad in and of itself, but you can also sort of intuitively understand that if earnings are going down and stock prices are going down, it's not necessarily good for stocks. So that's kind of how I think about it.
Understood.
I think there's room for a quick bout of deflation, but I think because the Fed is so afraid of it, that they would do everything they possibly could. And I don't know if they could or couldn't, but experiencing deflation myself, it's kind of un-American in a weird way. And we've all experienced deflation in those things behind Jim there and my big TV up here. And I'm talking about displays, right? And I remember sitting around saying, wow, I really want to get, they got a 65-inch TV now, and I really want to get it.
But $8,000 is a lot of money.
Yeah. I mean, watching it for a lot of money, but watching the price of those things drop, the 45-inch used to be $3,000. Now it's $800. The 50-inch used to be $2,000. Now it's $1,500. The 65-inch now is $3,000. I'm going to wait. This TV is perfectly good, and I'm still like that with televisions. Still like, I'll wait for Black Friday. I'll wait for the price to go down. I'm always 2 TVs behind. So I have experienced why the Fed fears it. So I'm just curious, and I don't honestly have an opinion, if there's a period, like a light period of deflation that the Fed then aggressively tries to fight, would be good for the economy, or is it just too much of a disease? I think we've come to the agreement that it's probably too much of a disease.
Ironically, I feel like the example you gave was a great case in point. Like, who benefits from that dynamic? You do. Who suffers from that dynamic? Yeah, all the producers of goods, right? Goods and
the stocks of those producers, right?
Yeah, exactly right. Exactly right.
So let's pivot to outlooks, and you're a longer term, investor than we are. We're traders to a certain extent, although like the last couple of weeks I don't think I'm a trader anymore. No, I'm just kidding. As if sometimes you have bad spells and you just can't get it right. So tech, Mag 7, NVIDIA, they showed its vulnerabilities on the 27th when they got punched with the DeepSeek story. Did that expose anything to you in those names? Do you think they're stretched valuation wise? Is it part of your thesis for 2025?
I tend not to frame it as much in terms of valuation, just because it's so hard for me to prove that valuation matters quantitatively over any meaningful investment horizon. I mean, I think if I had a pension fund client with a 10-year horizon, I could talk about valuation. But even as short as 5 years, which isn't short, the correlation between today and forward returns is just basically non-existent. And I think that, investors, and myself included, have to be honest about their investment horizon. Mine's not really 5 years. That's not the way. I don't have any edge in 5 years out. I view my edge as being something like 18 months. What was the second part of the
question? Then let's look at 18 months. So you look at the Mag 7, you look at NVIDIA, look at Micron, all of you. And do you think over 18 months that that's where you'd prefer to be? Where is it on your list?
No, I mean, I think that they still go up. And essentially the reason is this, the sector with the closest correlation to the economic growth data is actually technology. And I don't think a lot of investors appreciate that, because they view tech as being this, it's not cyclical like a mining company. So maybe it's not correlated to the growth data. It's not cyclical. It is cyclical. It's very cyclical. So if our view is that growth is going to accelerate, it's really hard for us to be bearish technology stocks. So we don't think this is like the top of the .com bubble or anything. That said, I do think that we're probably primed for some factor rotation, some sector rotation away from large cap tech into small cap cyclicals, stuff like industrials, maybe even basic materials, financials. Regional banks are one of our favorite allocations, have been for a while. We think that they're going to continue to do very well for the next year or so. So long story short, I think technology does fine. Certainly not like a mind-blowing short opportunity, over the next 18 months, but probably lags, some less sexy exposures.
So are we still, and by we, I mean you, of the opinion that the small cap, like, would you look at the Russell, for example, with the small cap index going to outperform in the near term?
I think so. Yeah. I mean, yeah. if you put a gun to my head and say, which major index will outperform over the next 6 months or 12 months? Yeah, I would go with the Russell over the NASDAQ or the S&P or the Dow or whatever. Take your pick.
So that's an interesting
story on that, Jimmy. I was on, I don't know if Taylor's still listening. I was on CNBC one day, and I said, if you put a gun to my head, I'd do this. And it was the day after a school shooting, and I got in a lot of trouble for that. We do have a question from It's Stock Charts, which
that's Remo, right?
Yeah, that's Remo, but it says 9:49 p.m. I gotta ask Luis in the back if that's a legitimate. I don't know what that is. 9:49 p.m.
Maybe where he is. I don't know.
Yeah, maybe it is. But we should put that up, Luis, if we could, because it's a legitimate question. I think all three of us will chime in on that, because Jim, you have a little bit of a different theory. I'm gonna read it in case. There it is. Lower energy costs, most effective in fighting inflation. Obviously, the administration thinks that's the key to it all.
Mike, you do too, probably, right?
Almost unquestionably, yeah.
No. I'm about to question it. You go, though.
There's nothing you can do to affect inflation rapidly than lower energy prices. I can't think of any. A government mandate to fire everyone? Lower oil prices is.
Here's my debate then. Okay, let's say oil prices start to go precipitously higher, like they're shooting higher. Okay, and that is taking money away from the consumer. You have to spend more money on crude, and I know everyone inputs, so everything is costs more to make, so they're going to pass on to the consumer. Not if the consumer has no money left, because they're spending it all on energy prices and they're completely tapped out. I'm not saying I still overwhelmingly believe. Not overwhelming. I believe that higher energy is inflationary, and I believe that lower energy. And by the way, my example is more about energy prices going higher. I don't believe that it necessarily has to be a flip side if it's going lower. When it's going lower, I think that probably does, because it filters through to the consumer very well. But will you give me that there's any chance at all that higher prices at the pump zap liquidity from the average consumer and leave less to drive up prices in other areas?
So the paradigm that we use for inflation at Invictus is kind of like the Milton Friedman one. He says inflation is always and everywhere a question of money supply, but the second part of that, which gets ignored a lot, is it's money supply relative to the growth and output of goods and services. So, theoretically, there's two variables there that can drive inflation up and down. There's money supply insofar as it affects consumption, and then there's growth and output of goods and services. So higher oil prices restricts real growth, right? Like if I need if I need 100 barrels of oil to produce all of the widgets in my business, but all of a sudden I can only afford 80 barrels of oil, then real growth is cut by 20%, right? And so, that's the mechanism by which we view oil prices and their impact on inflation, which is why we say, cheaper oil basically allows everyone that produces everything to produce more of it. They don't necessarily have to. It's a little more complicated, but all else equal, lower oil prices should be disinflationary.
Yeah, and I believe you on the low side. I just sometimes question the high side, particularly because the higher oil prices can come from oil shocks, from supply concerns around the globe, and that comes into conflict with Milton Friedman. Inflation is always and everywhere, blah, blah, blah. So I do think there's a chance. All I'm saying is I'm not 100% convinced. That's all it is.
You actually disagreed with Mike and Milton Friedman on the same show.
All at the same time, right? So who's the idiot? Me. I love this question, by the way, too, because when you said Russell, I thought Russell hates high rates, but they do like domestic growth. They like small business optimism. So what's your thoughts on this question?
So, yeah, I think everything that you just said is right. I think domestic, companies should benefit from Trump's trade policy. I think clearly to the extent, generally when the NFIB index goes up, the Russell outperforms. So when small businesses are optimistic, generally small caps outperform large caps. Also say on a technical basis, we saw a big momentum thrust in the Russell. It was like a 3 or 4 standard deviation move over the course of 2 weeks. If it was in July, I think, if you remember that. Historically, that's been a very good indicator of Russell outperformance over the subsequent year. I'd say if you look at the ratio of the Russell 2000 to the S&P 500, so small caps to large caps, and just sort of evaluate it on a technical basis, it looks to be sort of rounding out a bottom. And then finally, I'd also say economic conditions are supportive of small cap outperformance right now. So historically, when economic growth is accelerating, small caps tend to outperform large caps. It doesn't happen every single cycle, but it increases your probabilities by a lot. So right now, growth by most measures is accelerating. We expect that to continue. So in our view, that increases the probability of the Russell 2000 or the S&P 600 outperforming the large cap counterparts.
We had Ed Dowd on our other show, which will be released soon. But one of the things that struck me, he's former BlackRock and he's left there since, lives in Hawaii and does a lot of statistical analysis from the COVID period. I'm sure you know he is. He said, we may be in a recession and we're definitely getting one. You obviously don't agree with that. Can you see his side of that thesis? And if not, what do you think he might be looking at that's got him completely wrong? Which I guess is the same question.
So, a couple of things. So first, I think that you can't really have a recession without layoffs. Where do we see any kind of meaningful, worrisome risk of layoffs? Well, manufacturing and goods producing payrolls more broadly. We've seen layoffs 3 or 4 of the last 5 months, which is noticeable, right? That's not a good thing. And the reason it's not a good thing is because through recessions, goods producing payrolls account for 95% of layoffs, right? So seeing weakness in that part of the economy is never good. You never want to see it. It's a big red flag. Again, in this instance, I think that data is more likely to improve than get worse in the coming months, but it's something that we're aware of. I'd also add that some of President Trump's policies are, they're financially restrictive, right? Like letting go of 3 million government workers, if that ends up happening, is financially restrictive. All that income, doesn't go into the economy anymore, doesn't get spent on goods and services. And, could that it could certainly blast a hole in the DMV. Could that blast a big enough hole in the national economy to cause things to sort of derail and go into a recession? Maybe. I will say if it's paired with tax cuts, I think it's very unlikely. right? Basically, if you're able to replace that lost income with increased money creation from tax cuts, I think it would be net accretive to GDP growth. And I also know that President Trump and congressional Republicans are trying their best to do tax cuts. So I don't think that that's off the table at all.
So, Cameron Dawson, we spoke to her yesterday, and she said she doesn't think corporate tax cuts are coming, corporate tax cuts in any way. And she thinks because the world would view that as bigger deficits, bigger debt, which, to her point, yes, I believe it would. I didn't agree with her, and I didn't challenge her on that because we didn't have time. I say that if they think we're deregulating and cutting taxes, I think we could run bigger deficits, and the globe would still buy our bonds thinking that we're on the right path that could pay dividends in 2026. Am I stupid?
No, I think that's right. It's probably a conversation for a different time, but I think that Stephanie Kelton and the deficit myth makes some good points about how to view the national deficit and the national debt. And, essentially she says that they're policy tools, right? And I think that's historically how Democrats have viewed the deficit and the national debt. I don't think that they would explicitly say that they're modern monetary theorists, but, historically they're willing to spend money to accomplish their policy goals. And historically Republicans have been, more hesitant to do that.
So maybe,
maybe. I think the answer is maybe, yeah.
Bobby, before I'll give you the last question, I wanted to say that I have been considering reaching out to Stephanie Kelton. We used to have a dialogue. I disagree with much of what she said. I thought the book, The Deficit Myth, was a wonderful read, but only in the sense that it was like a Stephen King horror novel to me. But I'd like to get her on the show because we have so many people that we agree with on the show. I would like to get someone to have a respectful debate. You'd be for that, right?
Oh, absolutely.
By the way, we don't agree with Mike all the time, right? That's what you're about to say, right?
Well, I would say the deficit myth, I think the first half of it, where she's going through sort of the plumbing of the Treasury and the central bank, is very good. And I think she's very knowledgeable and it's impressive. The set of policy prescriptions that follow from that, I pretty much categorically think are bad ideas.
Yeah.
But that's essentially an ideological disagreement. It's not a disagreement about economics. So I went into it expecting to disagree with her on everything. And I walked away thinking she's really smart. I don't agree with her politically on stuff.
Okay, good. But I actually think that the notion of MMT, which basically is run deficits, whatever, too, if you worry about inflation, you quickly raise taxes to zap liquidity out of the system. Well, there's two problems I have with that. They've never shown that they're great at identifying inflation, and the notion that they can is idiotic. They missed it in real estate, they missed it in tech stocks, and those were bubble creation things. So they've missed inflation before. And then the notion that they quickly raise taxes, depending where we are in an election cycle, they will not do that. So it's all about, the economist saying, sure, it works in practice, but how will it do in theory? This is like the flip side of that. It is a wonderful theory that cannot possibly work. Does that make sense?
Yeah, that's my takeaway, more or less. That's a good summary.
You also can't, it doesn't even matter in terms of where we are in the election cycle. You can't quickly raise taxes. You also can't quickly cut them, and they probably won't. I mean, I think MMT is flawed because there's humans involved.
Yeah,
not necessarily the economic theory of it.
Yeah.
She also seems to assume that the Treasury and the central bank are essentially like a joint monetary sovereign, which is not how it functions in the United States. I don't really think she acknowledges that in the book, or maybe she thinks that they shouldn't be independent. But anyway, she makes good points, but she makes some assumptions that, like you said, that just don't really make any sense.
I called her the Oppenheimer of our time, which I don't think she really loved that, by the way. But Bobby, last question for you.
Yeah, two real quick questions. One is for both of you. Do you know the difference between an autobiography and a memoir? Does the person have to be dead? I don't know.
No idea.
The reason I ask that is I'm reading Patriot, which is Alexei Navalny's memoir, and he's dead.
Yeah.
And
he was killed, right?
Yeah. Well, he was murdered by Putin via poison. At least that's what everybody thinks. Putin denies it. But I've been dog-earing a bunch of pages where so much of what he went through, like in the 90s, feels like today with Soviet society, and feels like the last administration. It's not a political statement. I can talk about it one day on our other show. I'll bring in the book and I'll read the dog-eared passages. You guys will recognize stuff. But that's why I asked. But I do have one last question for Mike, and it's actually a question that was asked by me of Tim, who's a friend of the show as well. He would have had a question. He's not watching right now, or he would have had a question. Do you watch Money Flows? and do they mean anything to you? Because I asked Cameron Dawson the same question. One thing that Tim pointed out is he's seeing a lot of CEOs selling. Something Cameron pointed out, a lot of C-suite people are selling while the companies are doing buybacks, which is interesting in and of itself. Do you guys watch money flows in Invictus? And when you're done, tell people where they can find you.
Sure. So we watch it for our weekly trade ideas, specifically in sectors where we're not specialists. So maybe like biotech. Generally speaking, when we screen for biotech, we screen with a greater emphasis on insider buying, just because the outcomes for biotech stocks can be so binary that we feel that really sort of cuts the left tail a little bit, right? If an insider is buying, $1 million, $5 million, $10 million worth of stock, we think that really improves our batting average as investors. Unfortunately, despite that, our biotech thesis hasn't really played out as we'd hoped over the last 3 to 6 months. But at least we know that we're losing money with Deca Millionaires. So that makes
insider selling can be for any reason, right? The guy might just want a new Lambo.
Right. Insider
selling right now, you'd be an idiot not to be selling right now after the run and tax, to be squaring your position up and mitigating your risk a little bit. I'm in contact now with someone who's got a multi-million-dollar position in his tech consulting firm, and he's trying to figure out how to collar it. I mean, that to me makes perfect sense. Insider buying, which I don't actually seek out, but when the information is presented to me, I think that that's important. I don't, insider selling at these levels seems legit to me. That sound good, Mike? And then tell them where to find you, because we got to wrap up. Our producers are going to kill us.
Right. That's exactly right. We don't really look at insider selling as much because they might be selling to send their kids to school or buy a house or whatever. There's a million reasons. Anyway, you can find me at Invictus Macro on Twitter. Our website is invictusresearch.ai. And please take a look at our research products. We have a variety of products, daily, weekly, monthly. The daily is sort of the flagship product. It's called the Daily Edge. It's a 5 to 10 minute overview of the prior day's economic data and financial market moves.
It's excellent stuff. Yeah, I'll take it from here because you might not bump it up as much as I want you to. Mike's stuff is fabulous. The first time we met him was a couple of years ago, and we're like, what the hell does this kid know? He's younger than our kids. And all of a sudden we're like, oh shit, he knows a crap ton. And we are big fans. I read your stuff every morning. I think it's fantastic. And I thank you for putting it out because you are amazing in my opinion. So anyway, we are running up against the wall. We want to thank you guys all for being here, by the way, too. Bobby and I's history, we were 25 years in legacy media. We found in legacy media, you couldn't always give your proper opinion because you were always at the whim of some overzealous producer or sponsor. We want to be on platforms. We can give our honest opinion. Even if our honest opinion is wrong and it's bullshit, it is our honest opinion. We have great guests. Mike from Invictus is one of them. Mike Singleton. Please go to his website. Sign up for his daily newsletter. It is fantastic. I'm Jim Iuorio. That's Bob Iaccino. This is the Trader's what is this? The Trader's Edge. I'm the Tradier. Everything was good right up until that point, and then it just completely crumbled. Thank you for joining us on Tradier's The Trader's Edge, and I'll be better next time.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.